Good morning. This is Larry Edelson for my Uncommon Wisdom video for Thursday, February 3rd. I hope everybody had a good weekend last weekend and a good start to the week. The markets, I want to get right to my major point for this week's video. The markets are all in what I call chop city, which means that they're moving up and down quite violently, and they're going to chop up short-term traders with a lot of losses and a lot of sideways action. This is largely due to the fact that last week and in my Uncommon Wisdom Monday column, I showed everybody how many of the important cycles are now in a transition phase, and they're indicating that the next big move, while it's certainly around the corner, is not yet here yet. So the markets, all of them, all the major markets are floundering and swinging wildly, kind of trying to find their next positioning for their next big moves. Short-term traders typically get professionals on the floor of the exchange and experienced professionals. This can be a very profitable time, but for your average investor, these are the kind of markets that can really chop you up with lots of small losses. So I recommend that you stay out of the markets until I give you the all green on any of the major asset classes that I'm looking at, because I don't want to see any of you chopped up in this market. It could continue to be choppy for up to another 4 weeks. So knowing when to be on the sidelines is as important as knowing when to put the pedal to the metal and take on some positions. Let's go right to gold. Gold is now at a critical support level. Chances are we'll bounce back up to 1100 and change, maybe even up to 1160. You can see it has a potential for a wide swinging $80 trading range here from 1080 to 1160. It could be in that for the next 4 weeks, swinging up and down kind of wildly. On the other hand, if we do break this support level here, we'll probably move down to 1040, 1020. There will be no major long-term trend change if that were to happen. Gold would still be in a very, very bullish market, so you would want to hold your core gold positions. On the flip side, there's mounting evidence that we could rally back above here and then above 1160 and take off again. A lot of that will depend on the dollar, and I want to go right to that chart because the dollar is still grand central for a lot of the markets. Let me pull up a weekly chart of the dollar. Get this over to you, make sure it's in your full view. Just give me a minute here so that you can see the chart. Okay, here we go. This is a weekly chart of the dollar, and I want to show it to you because I'm seeing some very interesting stuff on it. Okay, one more second. As many of you know, the dollar's been rallying lately. It's been rallying lately because of the imminent potential for a debt default, sovereign debt default in Greece, also some concerns about sovereign debt in Spain and Portugal and Italy. These are valid concerns. So we're seeing a flight of capital, hot money driving into the dollar out of Europe, out of Greece, and pushing the dollar higher. However, as I've indicated all along, the long-term trend for the dollar is substantially lower, and this is just a short-term rally in the dollar. And one of the reasons I'm saying that is not only the cycles that I've been showing you over the past few months that point decisively lower for the dollar, but this weekly chart for the dollar is telling me some very important things. And if you look at these two red boxes here that I've drawn in, this is the low in October, November of last year. We had sort of a triple bottom. One, you can see here, 1, 2, 3, and then we got a rally out of the dollar. We got a decline. We got a rally back up, a double top formation. And then we came back down recently, and we came almost to record lows in the dollar index, right down into here. Now, let me widen this out a little bit. If you see this formation right here, it is I can tell you from experience, okay, this is a very, very weak formation that will not last in the dollar. It is merely a temporary bottom. When I combine the weak formation here with the fact that we had 3 attempts at a breakthrough to the downside back in '09, a 4th attempt here, the more market attempts to break through a support level or break above a resistance level, the higher the odds that eventually it will go through that level and make a substantial move. In this particular case with the dollar, I believe that we're running into some massive resistance right up here that I told you about, 79 to 80. Maybe we can get up to 81 in the dollar index. I'm beginning to get very skeptical that we can get that high. The next move for the dollar will be back down. The 5th attempt at this area, right in here, where these cluster of lows, 2009 and late 2009 were made, will likely see the dollar crash through that area and begin a major slide, probably to 68, 65 on the dollar index. So my bottom line here is don't get caught up in the rally in the dollar. It is merely temporary. It should be used for hedging against the long-term decline in the purchasing power of the dollar by inverse ETFs, and for more aggressive speculators taking outright short positions in the dollar. Right now, until we see a clarification of what's going to happen here in the dollar index, gold is going to chop sideways, and pretty much so is the Dow. Let me bring up. Okay, here's the Dow chart that we've been following all along for you. Pull it back down for you. Last week I noted how we came down crashing through this support level. I said that in the middle of this triangle here of white space we'd find support. Yes, we did. It just above 10,000. The Dow has now rallied back up to 10,000 in change here, 10.3. Might get a little higher up to 10.4. We will probably then trade lower and chop around, probably pierce below 10,000 and fake everybody out, and then we'll get the next big move. The cycles for the Dow are still very much in transition, as I showed you in some cycle charts over the last couple of weeks. If you're trading stocks or you're positioning for stocks, this is also not a time to be aggressive in any way, shape, or form. It's chop city in the Dow. Patience is the byword here. That's how the most money will be made. Not by trying to take every trade that comes along or every opportunity that you think comes along. It's nerves of steel and patience that will make the big money here. And that's my best advice for the next few weeks until I get some clarification signals, in which case I'll let you know immediately. Till next week, this is Larry.